In most accounting textbooks, the first 4 chapters cover what's called the accounting cycle. The cycle is what repeats annually. It's the high-level view of everything an accountant does during the year. The accounting cycle could be broken down into steps. Here I've written 7 steps, but there's nothing sacred about the number 7. I've seen textbooks that tell you the cycle is 8 steps or 9 steps or 6 steps. I have put in bold the most significant steps, and I've put in a light gray the insignificant steps. The light gray shows that we're going to make a trial balance 3 different times. Okay, step number 1. Enter the transactions into journals and ledgers. Step 1 is what we do all year long. Now, step 3 is, at the end of the year, adjust any account that is not perfect. That's called adjusting entries. Step 5, after you've adjusted your accounts and you're happy with all of the balances, you think you could defend them, you think they're correct, then step 5, you make your financial statements, and step 6, you close the temporary accounts. I've picked a few slides from previous videos that will help us to see the big picture. So here's a slide from an earlier video. This is a journal. These are journal entries. And here's a ledger, and we put our ledger entries here. The T accounts represent the 8-column standard ledger account, but I use T accounts because I can't fit the 8-column ledger accounts onto this slide. And every number that exists in the journal must also exist in the ledger. Journal entries and ledger entries is what we do all year long. We usually batch our work so that we don't, one at a time mark these transactions into the books. At the end of the year, we print a trial balance. A trial balance is a list of all of our accounts and their balances. And we go through these account balances one by one, and we ask ourselves, is what the computer's saying, is it correct? So how would we do this? How would we inspect the computer? Well, let's go through a few of these. Cash, $3,000. We would do a bank reconciliation and prove that number is correct. Accounts receivable, $5,000. Well, how would we prove that to ourselves? We would make sure that we have a list of customers, current customers, that owe us this money. If you can't come up with a list of the people that owe you the money, then you don't really have a good accounts receivable. And then I would write off any accounts that are unlikely to be collected, so that if it says 5,000, that's a number that we have to truly believe we will collect. Go to the next account, supplies. It says 2,000. Well, let's go count them really quick. And if we count 500, well, then we're going to have to change that 2,000 to 500. And on. You'll notice equipment and buildings, those have to be depreciated. So here is a page of 10 adjustments that we talked about in a previous video that we do at the end of the year. After we're happy that our balances are correct and what we want to show on the financial statements, we can make financial statements. There are 4 financial statements. The income statement and the balance sheet are usually the only ones prepared in a small business. Statement number 2, statement of owner's equity, is usually too insignificant for a small business. For them, it's maybe a footnote. The 4th financial statement is the statement of cash flows. And that's a hard one to prepare, so a lot of small businesses don't prepare it. But if you're a big business, that means you have a stock symbol and you're required to follow generally accepted accounting principles by law, then you have to produce a statement of cash flows. The important numbers on a statement of cash flows are those 3 middle numbers. not so much the beginning cash balance or the ending cash balance. It's where does cash come from and where does cash go? There are three categories. And lastly, remember we do closing entries. We had a video on this. The blue numbers were the balances in a simple small business. And we transferred those blue numbers over to retained earnings by inserting those red numbers in all those accounts. This is the two-step method of closing temporary accounts. The temporary accounts are revenues, expenses, and dividends, and they're closed at the end of the year to retained earnings. Now, most textbooks are wanting you to print trial balances all the time. They want you to print a trial balance before adjustments, after adjustments, and after closing entries. If you print a trial balance before adjustments, it would include numbers that you haven't inspected yet. That's called the unadjusted trial balance. Now, after you've made adjustments, you could print a new trial balance, and the author would call that adjusted trial balance. Now, here's an adjusted trial balance. We've used these numbers to make financial statements. After you make financial statements, you have closing entries. Now, let's look at what happens to the trial balance after closing entries. These yellow lines exist before the closing entries, but these are all temporary accounts. And so the closing process will move all of these yellow numbers to retained earnings. Let's notice a few things. Do you see the yellow credits add up to 180? And if you added up the yellow debits there, they would add up to 170. So if you net all those yellow numbers, it would be a net credit of 10,000. So that 10,000 is going to be moved to retained earnings. And this is what a trial balance would look like after the closing entries. The temporary accounts would have zero balances, and the retained earnings account would be incremented up. So back to this slide, you can see in the light gray the three times the author would say to print a trial balance: before adjustments, after adjustments, and after closing. But I think that the printing of the trial balance is just for your convenience. There's nothing sacred about that. In my mind, I would just say the accounting cycle is these four things. You make journal entries all the time, journal and ledger entries all year long. At the end of the year, you go through each of your accounts, you make them perfect, and then you do financial statements, and you close the temporary accounts. The temporary accounts are revenues, expenses, and dividends. And then you start the process over again, because that's what a cycle is. It just repeats.